Might start with you. It's finally becoming a little bit of a trend. We're talking good finishes on the local market.
It was a good day for the Aussie share market. The mark that we were watching today was 4,716 points, and that was a 200-day moving average. The Australian market managed to break that in the first 10 minutes of trade. I've just drawn a line on the intraday graph behind me, and then we saw some short covering giving the market an extra boost. But really, the Aussie market outperforming. We saw negative GDP confirming a recession for Japan. In fact, we're seeing the topics down by about 0.8%, and the Korean Kospi down by almost 2%, and yet the Australian market has managed a very strong rise. Part of that is our skew towards commodities. In the past week, we have seen a bounce back. Oil prices up by 1%, copper prices up by 4% in the past week, and our energy and our material plays doing extremely well. But also, I think we have seen a move away from the US market into some other economies and some other markets, like the Australian market. We saw some disappointing earnings coming through from Hewlett-Packard, whereas in Australia, the high effect of the Aussie dollar really priced in, although Deutsche Bank was a little bit late to the party today, downgrading our resource stocks because the Aussie dollar move has really outpaced that move that we've seen in commodity prices. But all up, the Australian market looking pretty good, and in terms of fundamentals, coming back to a really crucial market as well. If we have a look at the PE ratio for the S&P ASX 200, it stands at 14.7, and if I can bring up a longer term graph of the PE ratio, this is for the All Ordinaries Index over the past 20 years. I've just drawn a line at the lower end of the PE ratio mark from about 1995 to the global financial crisis, and you can see we've come back to that mark today. So really, in terms of PE ratios, coming back to what's been historically the lower end of the band for PE ratios for the market.
So impacting to some extent currency markets as well, downgrading the US dollar overnight, suggesting, do you think, more upside for the Aussie dollar, US dollar cross?
It's surprising that Goldman's has come out to downgrade the US dollar when we are facing the end of QE2. So it was really interesting to read this note which came out overnight from Goldman's in the US. And it does look like they are still down quite negative on the US dollar because of interest rate differentials, saying that it does look like the interest rate differentials are going to be a negative for the US dollar going forward. Of course, there are some risks to these forecasts, and if we have a look at their forecasts, they're predicting the euro to be at 145 in 3 months' time, 150 in 6 months' time, and 155 in 12 months' time. The risks to this, of course, the European debt situation. If we do see this blow up, then we could see the euro weaken off, but also I guess the interest rate situation in the US, if we do see rebalancing occurring at a faster rate, then we could see some strength coming through for the US dollar. But altogether, it does look like they're predicting another bout of US dollar weakness. And of course, that's great news for the Aussie dollar. So a key thing to be watching. We have seen the Aussie dollar bouncing back pretty strongly today. And it has been a time of real turbulence around the region where we are seeing the Japanese market down by about 0.8% on concern over that GDP number.
In particular, James Hardie, look, a horror headline figure, I suppose, in terms of their bottom line, or downgrade, I suppose, if you like. But really, it was a charge, wasn't it? $345 million charge relating to some legal action here in Australia. Strip that out, and operating profit actually a bit better than expectations.
Look, analysts usually look at the operating profit because we strip out the one-off items because they won't be reoccurring, and they don't really give you an idea about the underlying strength of a business. So if we have a look at operating profit coming above market expectations, and there has been some good news coming through from James Hardie this week, announcing that they will start to reinstate dividends in the current financial year, a 5% share buyback. But really, if you have a look at the key to James Hardie's business, it's their US business. It makes up about 90% of their earnings. And unfortunately, the US housing market's still looking pretty bad. We saw those US housing start numbers tonight in the US. We'll get the existing home sale numbers. And until the housing situation picks up, we are going to see James Hardie shares really not doing too much at all, or certainly no catalyst for any upside movement. One thing, I guess, to be watching, which could impact on the US market, is those Japan GDP numbers that we saw today. The contraction of 0.9% was around about double what the market was expecting. And if we have a look at the impact that this has in terms of the US economy, just if we have a look at auto production, in the first quarter, auto production accounted for 1.4 percentage points in terms of a positive addition to GDP. And of course, in the second quarter, this looks like it's now going to be a drag. So we could see an impact in terms of the US growth story because of what's happening in Japan. Of course, it's going to be short, but it does look like it's going to be deep, and it does look like there's going to be an impact.
And Lachlan,